Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another episode of Blue Chip Now. I am Daniel Ducina, Chief Investment Officer.
Matt Mondu, partner and senior financial advisor.
And Dan Cedar, managing partner.
Guys, is summer over? We're back after Labor Day. What did everyone do over the weekend? Anything fun?
I got a lot of summer over comments from the kids. My kids go to school today, first day, so it was a lot of the summer's over, and I reminded them we have some nice weather still to come. So not quite over, but yeah, we had fun. Kids played a lot of Ghost in the Graveyard at night, Friday and Saturday, and some pool time Sunday, and then a lot of laundry and throwing the football yesterday.
It's amazing to me how summer, when I look back at certain events earlier in the spring or summer, early summer, it seems like an eternity ago, but we're already in September thinking about what are your New Year's plans and what's going on this winter or the holiday season. I'm a bird hunter, so bird hunting conversations are coming up. So the transition from golf now into bird hunting, bowling, any other activity that's more of a winter-based activity is here. It's just crazy. Time really does fly faster and faster the older you get. But for us, it was golf. We golfed in northern Michigan. We were up there visiting my in-laws. So it's a great weekend, great getaway, perfect weather. It was absolutely perfect. You couldn't have asked for a better way to cap off the summer.
Yeah, shout out to the weather.
Shout out Mother Nature.
Yeah.
We love her dearly. Just trying to get some brownie points for hopefully she's listening. Give us continued good weather. Other kind of secondary effect of getting back in the swing of things post-summer is we're going to have a lot more market participants as we turn the page to September. For those that watch this type of stuff, volumes can get pretty darn muted through months like August. And so while it's usually not super important, as people get back in the saddle, you will potentially see some volatility on the back of that, both to the upside and the downside, potentially. But at any rate, we're not going to go down that rabbit hole today. What we would like to talk about today are a few different things. We want to talk about recent tariff updates, ruling, and potential market reaction. We want to talk about what's going on in the bond market, some potential ripple effects to changes in interest rates. We want to talk about some pressure that we're seeing on artificial intelligence-related companies in the U.S. equity market. And then finally close out by some quick comments on market tone, investor sentiment, and what we see is coming down the pipeline for financial markets here in the U.S. So I'll kick us off just to start talking about some of the more domestic foreign policy items that have emerged. So we all know that the tariff conversation has been one of the larger drivers of not just U.S. but global financial markets this year. More recently, a U.S. appeals court ruled most of President Trump's reciprocal tariffs were actually illegal. And even though they remain in place till at least October 14th, as the case is heading to the Supreme Court, this legal ambiguity has fueled a lot of uncertainty. And so even though we have a rate cut that's priced into, seemingly priced into markets right now, the potential $100 billion in tariff refunds could impact yields in the bond market and other fiscal dynamics. So too long, don't read. There's a lot of shakiness going on right now as it pertains to foreign policy, and there's potential for read-through into fiscal policy here in the U.S. and bond yields.
I wonder if this is just a way to push back and create some political red tape to slow down the process. I mean, it seems like it would really be a step back now, and without identifying if the steps that were taken to get to this point were legal or illegal. There's been progress, and I feel like we're moving in the right direction. So I'm concerned that if there was some type of clawback or change to what has been done, that would have a negative impact on the markets.
Yeah, I mean, I think what's interesting to me, or my thought generally here is, how difficult it is to run a business when you're dealing with this cloud of uncertainty with tariffs. And you start to question, whether or not we have seen all of the price increases or inflationary impacts of the tariffs yet. Because if you're a business owner and we've kind of waffled on percentage rates, do you really know how much you should increase the price of your product or how much you can pass along to the consumer yet? And you start to think about, a great example are, electronics or autos where they have, release dates of the new product, the new next year's product. And, will we start to see the prices get impacted more when the new model years come out, so to speak, versus, kind of incrementally dripping, 2-3% here or there. So I'm interested to see what happens. There's just a ton of uncertainty. And like I said, I mean, how can you really price products when we're all over the map?
Yeah, but the uncertainty is already there on what the outcome of the tariffs are going to be. Now there's uncertainty whether the tariffs in and of themselves are legitimate in the process that was taken to get to the point that we're at. So it's what do you even say about this? What do you say?
There's not a whole lot I can add, to be honest.
I think we're just identifying that that's out there because it's impossible to really pass any judgment at this point. This could go in any direction.
Well, realistically, I guess what I can kind of talk about as it relates to that, to me, the more important side of things is the reaction that you're seeing in bond yields. This, along with the anticipation of rate cuts from the Federal Reserve, are causing some volatility in global bond markets. Right now, you have U.S. 30-year Treasury yields approaching 5%. You're also seeing this come at a time where there's some stress in the U.K. and French bonds over fiscal instability. In the U.S. in particular, in addition to some of the tariff-related items we just talked about, these yield spikes could be reflecting increasing fears of fiscal mismanagement and potential policy missteps. I mean, to me, Matt and I were catching up about the 30-year bond yield right before we started recording. And I think people like to make a conversation whenever you get bond yields that hit a certain level. So for the 30-year getting close to 5%, that's clearly going to be a talking point. It's a level that would be termed as high, quote unquote, relative to the last 10 years. But if you zoom out, I mean, the 30-year bond, at least from a U.S. Treasury perspective, trading at 5% is still very low relative to broader history. And you have seen the 30-year bounce off that 5% measure multiple times going back to 2023. So I don't really think this is, to me, I don't like to make more out of this than needs to be made out of it. I mean, the direction of the Federal Reserve is very clear at this point, and I don't think there's any reason to nickel and dime investors for trading on certain levels.
We talked about the 10-year in the past with regards to a Fed rate cut, and that could actually result in a spike in bond yields. It doesn't mean that the longer dated treasuries or maturities are going to drop alongside the short end of the yield curve when the Fed cuts. So the Fed controls the short end of the yield curve. The long end can still go higher in a rate cutting environment. And I think this is one example of that. So,
and the reason being, the market would be potentially pricing in more inflation. The market's saying this could be a policy error. If you cut rates, we could have higher or sustained higher inflation. Doesn't mean high relative to what we witnessed in COVID, but 3%, 2.5% for a longer period of time is kind of the policy mistake that the long bonds could potentially be pricing in.
Yeah. Well, in and of itself, anytime you get longer maturity bonds, you have the yields rising. It's basically just investors saying, hey, I need more for my dollars invested. It's just investors demanding a higher risk premium.
Yeah. And inflation kills bondholders, full stop, right? If you were getting paid 5 and inflation is 4, your real return is 1. That's not good.
But isn't the long end still a reflection of economic growth and in the direction that we're heading over time? And you'd rather see the 30-year at 5% than 2%.
I think it's all things. And it's tough I think that's what investors have to parse out. Is this because of growth expectations or is this because of inflation?
Yeah,
right.
Or maybe a combination too. But yeah. I don't think it's unhealthy. It seems like it's still at reasonable levels.
Yeah. Well, I mean, in other news, we want to talk just kind of on the other side of the book here in the stock market. Artificial intelligence continues to be not just from a business perspective, a very prominent theme, but within financial markets, artificial intelligence and related companies have certainly been a major driver of performance this year, just as they were last year and the prior year as well. What we've seen recently is some AI-related stocks are facing some renewed selling pressure. You saw NVIDIA sell off quite a bit following their recent earnings report. Within that, you heard Alibaba is developing its own artificial intelligence chips. Basically, you have investors that are looking for any excuse to ditch some shares of NVIDIA, because I think competition is very much top of mind for investors in NVIDIA. And you've had some of the selling pressure extend to other names like Advanced Micro Devices, Taiwan Semiconductor, Broadcom, and other names. So I guess the headline here is that sentiment as it pertains to technology stocks is pretty fragile. And given the level of concentration that investors might have in their portfolios with regard to technology, I think people are watching it pretty closely. Do you think this caution is warranted, or what's the pulse that you guys have right now as it pertains to that type of allocation?
Well, it seems like it's a very one-sided trade. I mean, everybody's holding the same few stocks, and whenever you see that, these are the outcomes that you'd expect, right? This is a trade or holdings that are very tilted towards U.S. large cap, AI-centered technology stocks.
I think more in terms of price for perfection. I don't know exactly what the differential is in valuations when you look at the high-flying tech names relative to the rest of the market, but I think it's an opportunity for the rest of the market to catch up. Even if the tech names were to pull back, there's other opportunities. So I think it's a reflection. Right now, it's more important to stay diversified and not be as concentrated in those areas. Doesn't mean those areas can't continue to go, but I think you want to be diversified and own other segments of the market.
Yeah, which has been tough to do, right? When it's the same 7, 8, 9 stocks leading the market, diversification is not paid. But when you see moves like this, that's when it's a nice reminder that diversification over the long run does pay.
Well, and I guess kind of following on that, with some of that more critical sentiment that you've seen in the high flyers, you have seen over the last month, when I look at performance through the month of August 2025, you have seen a bit of rotation. That's evidenced in sectors like energy and financials doing really well. One of those better than technology over the previous month, but then also parts of the market like small caps, which have been somewhat left behind in aggregate over the last 10 years, albeit with fits and starts, but small caps outperforming large caps over the last month. And then finally, just the average stock, call it the S&P 500 equal weighted index or the Russell 1000 value index, some of those names that have been left behind in the rally, those outperforming tech names would indicate to me that you're seeing some level of sentiment-driven reversal in market leadership. And again, I would argue that's healthy. Anytime you get a very one-sided market, a very concentrated market, that just can stoke volatility. So I'm watching that really closely.
And the general markets have been really resilient. Okay, at the end of the day, markets are still at all-time highs. Right now, we're just at the point when investors start questioning, well, have I missed it? If I had cash on the sidelines, is it too late? I don't think it's too late. I think it's a great time to invest. I just don't think you continue to pile into the names that have worked the best when you look back over the last few years. So I think it's just a better time to be diversified, look for other opportunities.
Yeah, I'd agree with that. Any other closing thoughts before we kind of recap and round out this episode?
That's it.
That's it. Yeah.
Okay.
Let's go Lions on Sunday.
Yeah. Football is back, and just as a bit of a summary, we covered a bit on some of the legal battles that are forthcoming over tariffs. Covered some aspects of bond yields and our thoughts on the fiscal situation. Talked about the tech sector and the concentration in artificial intelligence, some changes in sentiment that we're seeing, and then finally, we hammered home what we would view as the importance of diversification and how market leadership can rotate month to month, quarter to quarter, year to year. So, thanks so much for joining in for another episode of Blue Chip Now. We look forward to speaking with you all again soon.